On the morning of December 17, 2025, people across the United Kingdom awoke to headlines that no one had quite expected. The news was everywhere, on the front pages, on TV screens, and lighting up social media feeds. Overnight, a sense of surprise and cautious hope swept through the country. The latest data revealed that inflation had dropped sharply to just 3.2% in November, marking the lowest level seen since the early months of spring. For months, inflation had been stubbornly high, squeezing household budgets and fueling anxiety about the future. Now, suddenly, the numbers were moving in the right direction. The scale of the drop caught almost everyone off guard. Financial analysts who had spent weeks poring over forecasts had predicted only a modest decline. Even the Bank of England, with all its resources and expertise, had not anticipated such a dramatic shift. The unexpected nature of the fall sent shockwaves through financial markets and boardrooms alike. For ordinary families, the news brought a sense of relief that had been missing for a long time. After months of watching prices climb higher and higher, at the supermarket, at the petrol station, and on their monthly bills, many people finally felt a glimmer of hope. Some even dared to imagine that the worst might be over. The Bank of England's policy of keeping interest rates high seemed to be paying off. Optimism spread quickly, with commentators and everyday citizens alike speculating that the era of relentless price rises might finally be ending. The mood on the streets and in the markets was noticeably brighter. Politicians were quick to claim credit for the turnaround, holding press conferences and giving interviews to celebrate the positive news. Newspaper headlines blared with optimism, and many assumed that lower interest rates and perhaps even a return to economic normality were just around the corner. Yet, as the celebrations continued, some experts urged caution. Beneath the surface, the story was more complicated than it first appeared. The sharp drop in inflation raised as many questions as it answered, and not everyone was convinced that the good news would last. Economists began to debate what was really driving the sudden change. Was it a sign that the economy was finally stabilizing, or were there hidden factors at play? Some worried that the drop could signal underlying weaknesses, or that it might be a temporary blip rather than a lasting trend. In economics, good news can sometimes hide deeper problems. As the country celebrated, a new set of questions emerged, about the future, about stability, and about what might come next. At first glance, a sharp fall in inflation might sound like a reason to celebrate. After all, lower prices usually mean more money in people's pockets, right? But in reality, a sudden drop in inflation isn't always a sign of a healthy, thriving economy. Sometimes it's a warning that things are not as rosy as they seem. In fact, a rapid decline in inflation can mean that people have stopped spending, not because they're saving up for something special, but because they simply don't have enough money left. When households are forced to tighten their belts, they cut back on everything from groceries to nights out, and that lack of spending ripples through the entire economy. That's why the recent drop in UK inflation has some experts worried. Instead of being a sign of economic strength, it could actually be a signal that the economy is weakening. Businesses are seeing fewer customers, and the financial sector is bracing for tougher times ahead. To understand this, think of the economy as a car. When inflation is high, it's like the engine is overheating. The Bank of England raises interest rates to cool things down, hoping to bring everything back to a safe temperature. But if the brakes are applied too hard, the car can slow down so much that it stalls. In economic terms, that's what happens when demand collapses. People and businesses stop spending, and growth grinds to a halt. This is why financial markets have reacted nervously to the news. The pound has fallen against other major currencies, and investors are watching closely for signs of deeper trouble. For many investors, the drop in inflation isn't a victory. It's a red flag. They see it as a warning that the UK economy could be heading for a downturn, rather than bouncing back. When people and businesses are too worried to spend, shops and restaurants sit empty and small businesses struggle to survive. Instead of healing, the economy starts to shrink, and the effects are felt everywhere, from the high street to the home. The very medicine used to cure inflation, higher interest rates, may have pushed the UK closer to recession. Families are finding it harder to pay their bills, and headlines warn of tough times ahead. So, sometimes, what looks like good news on the surface, a sudden silence in the economic engine, might actually mean the engine has stopped, not that it's running smoothly. It's a reminder that in economics, things aren't always what they seem, and we need to look deeper to understand what's really going on. Recent data shows the UK economy is under strain. The economy shrank in October, driven by falling consumer spending as households tighten their belts. The job market is cooling, unemployment is rising, and job vacancies are falling. Wage growth is slowing, making people more cautious with their money. Retailers responded with deep discounts, especially during Black Friday, to entice reluctant shoppers. These discounts pulled down inflation but also revealed weak demand. The inflation drop isn't happening in isolation, it's part of a bigger story of a slowing economy. The Bank of England now faces a tough choice. Have high rates gone too far? Their next move could tip the economy into recession or help stabilize it. The Bank of England's Monetary Policy Committee meets tomorrow, and the stakes are high. Markets expect a small rate cut, hoping to ease pressure on borrowers and prevent recession. But the committee is divided. Some fear the inflation drop is temporary, driven by discounts that could vanish soon. Wage growth remains above target, raising concerns about cutting rates too soon. If the bank cuts rates, it risks weakening the pound and reigniting inflation. If it holds steady, it could push the economy further toward recession. The decision is finely balanced and will send a strong signal about the bank's priorities. Tomorrow's move will shape the UK's economic path. For homeowners, the bank's decision has real consequences. A rate cut could mean cheaper mortgages. But if it's due to a weak economy, job security and house prices could suffer. Those with fixed-rate deals ending soon face a dilemma: lock in now for certainty, or wait and risk missing out on better rates. Acting now provides stability, but waiting could backfire if the bank surprises the market. The best choice depends on your risk tolerance and financial situation. For those on variable or tracker mortgages, a rate cut brings immediate relief, but future rises remain a risk. The mortgage market is a minefield, and every decision carries trade-offs. In uncertain times, certainty can be worth the cost. Investors face similar uncertainty. Lower interest rates usually boost markets, but if they signal recession, the outlook darkens. A rate cut might spark a brief rally, but weak economic data could quickly reverse gains. Safe assets like government bonds may do well, while shares in consumer sectors could struggle. The falling pound adds complexity, affecting overseas investments. Now is not the time for risky bets. Diversification is key. Spread your investments across different assets and regions to cushion against shocks. A balanced portfolio helps weather volatile times. The main driver of the inflation drop was a slowdown in food price inflation, with some grocery prices even falling. Aggressive Black Friday discounts, especially in clothing and shoes, also played a big role. These discounts lowered inflation but signaled weak consumer demand. Core inflation and services inflation also eased, suggesting broader cooling. However, the Bank of England knows these trends could be temporary. Seasonal discounts and one-off price drops may not last. The key question: is this the start of sustained low inflation, or just a blip? The answer will shape the bank's next moves. 1 month's data isn't enough to declare victory. The bank will watch closely before making big changes. With uncertainty ahead, there are steps you can take to protect your finances. Review your budget and identify areas to cut back if needed. If your mortgage deal is ending soon, speak to a broker and consider locking in a fixed rate for peace of mind. For savers and investors, avoid panic. Don't overhaul your strategy based on one news event. Build an emergency fund with 3 to 6 months' expenses in an easy access account. Pay down high-interest debt, as rates are likely to stay elevated. Diversify your investments to reduce risk. These actions strengthen your financial resilience, whatever the bank decides. Preparation is your best defense in volatile times. The UK stands at a crossroads as the Bank of England prepares its next move. The decisions made here will ripple through every corner of the economy, affecting not just financial markets, but the daily lives of millions. In these uncertain times, the eyes of the world are on London, waiting to see how the nation will respond to the challenges ahead. The recent drop in inflation looks promising on the surface, offering a glimmer of hope to households and businesses alike. But beneath the headlines, deeper problems persist. Rising costs, stagnant wages, and global uncertainty continue to cast a shadow over the recovery. Many families are still feeling the pinch, and businesses remain cautious about the future. The Monetary Policy Committee faces a dilemma that has no easy answers. Should they cut interest rates to stimulate growth, risking a resurgence of inflation? Or should they hold rates steady, potentially slowing the economy and risking a recession? Every option carries consequences, and the stakes have rarely been higher. For ordinary people, these decisions are more than just headlines. They shape the cost of living, the value of savings, and the security of jobs. Small business owners, young families, and retirees alike are watching closely, knowing that the outcome will impact their plans and dreams. Homeowners and investors must navigate a landscape where every decision carries risk. Mortgage rates, investment returns, and even the price of everyday goods can shift overnight, making it more important than ever to stay informed and adaptable. For many, locking in certainty, whether through fixed-rate mortgages or diversified investments, may be the safest bet in a world where volatility is the new normal. Seeking professional advice and planning ahead can help protect against sudden changes. The story isn't over. Tomorrow's decision will be pivotal, but not final. The economic landscape is constantly shifting, and each announcement is just one chapter in a much larger narrative. Staying flexible and prepared is key. Stay alert, pay attention to the reasons behind the bank's move, and focus on building personal financial resilience. Understanding the bigger picture can help you make smarter choices, even when the future feels uncertain. In an economy on a knife edge, preparation is everything. Building an emergency fund, reviewing your financial plans, and staying proactive can make all the difference when the unexpected happens. The best strategy is to stay informed and ready for whatever comes next. By keeping a close eye on developments and seeking out reliable advice, you can weather the storm and come out stronger on the other side.